Hello everyone and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, and in this chapter we are revising chapter number 14, which is divisional performance measurement and transfer pricing. Without any further ado, let's get started. The first topic that we have in this chapter is about ROI. So we have already learned the formula of ROI, but over here, because we are measuring divisional managers' performance, we're only having a look at, we're adjusting it to make it a suitable measure so that their performance can be evaluated. So we are taking the controllable profit only over here, and we divide that by the controllable capital employed. Controllable capital employed, multiplying by 100 to find out the ROI. Now, what are the advantages of using this method? Number one, that it's widely accepted and used. Widely used and also accepted. Then another advantage with this method is that comparison becomes easy with other divisions or other companies. So it enables comparison. Another advantage is that it can be broken down into secondary ratios for detailed analysis. So can be broken down into secondary ratios for a detailed analysis. Now, nothing comes without its disadvantages. So let's discuss the disadvantages also. Number one is that it may lead to dysfunctional decision making. That means just to prioritize having a higher ROI, managers may make decisions that may not be good in the long run, but they'll only help to improve the ROI. Another disadvantage is that it increases with the age of the asset if your carrying values are used. So as you know, the carrying values of assets goes down, your denominator goes down. So the ROI increases with the age of the assets. If carrying values are used. Another disadvantage is that it may encourage manipulation of capital and profit employed. So may encourage manipulation. Another disadvantage is that different accounting policies, different accounting policies. So perhaps using different methods of depreciation to come out at the capital employed. That's going to mislead. That can mislead comparisons. Can mislead comparisons. Now let's talk about another thing which we have learned over here in this chapter is residual income, also known as RI. So RI is nothing but controllable profit less your notional interest on capital. So whatever is your capital employed multiplied by the weighted average cost of the capital, that amount gives you the notional interest on capital employed, and subtract this from your controllable profit and you will have your residual income. Let's talk about the advantages. So the number one advantage that we have in this case is that it encourages investment managers to make new investments because, due to ROI being used, they may not invest in the new investments because they may think that the denominator is going to go up and ROI is going to fall. So this encourages investments. Then risk can be incorporated by the choice of interest rate that we use. So risk can be incorporated. Maybe you're using a higher uh, interest rate when calculating the notional interest on capital. So this way you are incorporating risk. Then it also makes investment managers more aware of the cost of the assets which are there under their control. So makes managers more aware of cost of assets under their control. Then let's also talk about the disadvantages. Number one is that it does not facilitate comparisons because RI is driven by the size of divisions and investments. So does not facilitate comparisons. Another thing is that it is based on accounting measures of profit and capital employed, which may be subject to manipulation. Then let's also talk about the common problems which are faced in ROI and RI. Common problems in ROI and RI. So there are two problems which remain common in both. These are both subject to manipulation and aging of assets. Then let's also talk about what methods can we use to compare divisional performance. So methods to compare divisional performance. So number one can be variance analysis. You can check out the variances of the divisions. Another method which you can use is the ratio analysis. Then you can also use other management ratios. And then there are others like staff turnover, market share, etc. So these are some methods to compare divisional performance. Then let's talk about transfer pricing. So first, let's know what transfer price is. So basically, transfer price is nothing but the price at which goods or services are transferred from one division. So let's suppose this is division A, this is division B. Maybe the raw material that this division uses is something which is the finished product of division A. So the price at which the division A will transfer the goods or the services to division B in the same organization is what will be known as the transfer price. Now, what are the objectives of transfer pricing? What do we aim to achieve with this? We aim to achieve goal congruence. That means, the goals of both of the departments and the organization as a whole are achieved. And then you also aim at performance measurement. You're seeing that, whether or not these divisions are performing well or are they doing bad. Then there is also the objective of autonomy, that, they both divisions have the full choices that what will be good for them. Then recording the movement of goods and services is also another objective. Recording movement of goods or services. Another objective is minimizing the tax liability. Every business wants to save on taxes, so this is also one of the objectives. Now, how do we set the transfer price? Setting transfer price. So there are basically two approaches. First is the cost-based approach. So when we talk about the cost-based approach, the transferring division, probably if division A is sending their products to B, A will price their goods on the basis of cost plus profit approach. So cost plus some percentage of profit. So maybe if the cost is 100 and the percentage of profit which they have set is, let's suppose, 10, so they will be supplying this at a price of 110. Now another approach which we have is the market based approach. Now, what happens in a market-based approach? You are pricing it according to the prices which are prevailing in the market. We'll also discuss the advantages and disadvantages of using this approach. Number one, advantage will be that it's a fair price because it's transferred at the market price. It's also a fair price which is charged in the market, and there is no negative impact on the company's performance because the company is earning the same, charging the same to the other division as much they would sell it in the market. So, no impact on the company's performance, no negative impact essentially. Then let's talk about the disadvantages if this approach is used. So the disadvantages are going to be number one, there may not be an external price. So maybe the goods that are we are transferring are not sold in the external market. So the external price may not be available. External price unavailable. Another disadvantage is that there will be an unstable external price for certain goods. So maybe the prices keep on fluctuating very quickly. So it's not really possible to arrive at one external price for those kind of goods for certain goods. And another disadvantage is that savings may be made from transferring goods internally. Definitely, when you are making something internally and that happens to be the raw material for the another department, savings can be made if the goods are produced and sold internally. So this method does not account for that. That's why this is a disadvantage. With this, we have come to an end to the revision of chapter number 14. In the next video, we're going to be meeting for the last and final chapter, chapter number 15 of the PM syllabus. With this, we are, finishing with the entire syllabus. I hope that this was useful. Thank you for watching.